Today we're going to talk about Chapter 18, Valuation and Capital Budgeting for the levered firm. We will talk about 3 different approaches to adjust for the effect of leverage on valuations: APV, FTE, and WACC. We will also discuss how to estimate the discount rate for a non-scaling project. Do you guys still remember Amazon was asking different cities bidding for the second headquarters? A lot of cities come up with a very impressive package, different kind of tax benefit, subsidies, if Amazon choose to have headquarters in their location. So when we consider using debt financing for our investment, sometimes we have additional valuation impact. The positive could be tax incentive, the negative could be financial distress. So in this chapter, we're going to look at the valuation, project value, and firm value with the leverage effect. We will go over 3 approaches: APV, FTE, and WACC. APV is based on net present value plus a separate component, which is net present value of financing effect. We will use unlevered cash flow discount at R sub 0, which is the cost of capital for an unlevered capital structure. Subtract a full amount of initial investment. The possible additional effect of that could be examples such as interest payment tax shield, local government subsidies, flotation cost, or financial distress cost. Second approach is FTE. This approach considers from equity holders' point of view. We look at the cash flow goes to the equity holder. It is named levered cash flow. Cost of equity, the amount of investment contributed by equity holder. The third approach is WACC. WACC responds to the effect of leverage by adjusting discount rate directly. Do you still remember we adjust the cost of debt with after-tax adjustment component? We use unlevered cash flow and full amount initial investment in the WACC. What's the relation between unlevered cash flow and the levered cash flow? Unlevered cash flow is total cash flow to both stockholder and bondholder. Bondholders receive interest payment. Due to the tax incentive, the interest tax shield, the net amount goes to lenders is after-tax interest expenses. So once we subtract this component, the amount cash flow goes to the stockholder. So we call this levered cash flow. In another word, levered cash flow is simply unlevered cash flow subtract after-tax interest expenses. Now we're going to go over several examples. The first example is a PB single example. The feature is based on perpetual cash flow. So the valuation is a bit easier. We will use cash flow over discount to figure the firm value. One project will bring in 500,000 cash flow every year forever. The operating expense is 72% of sales revenue. Discount rate R sub 0 is 20%. Company could finance the project with 126,229.5 in debt at 10%. The target debt to value ratio is 25%. Corporate tax 34%. Initial investment is $475,000. What is APV? So this example uses 2 assumptions. Number 1, cash flow is perpetual. Number 2, annual depreciation is updated every year, so there's no additional depreciation every year. So first, let's start with APV. APV we are based on net present value plus a second component or present value of debt financing. So let's start with net present value. We start with annual cash flow. For APV, we start with unlevered cash flow. Recall sales revenue is 500,000. Operating cost is 72% of 500,000. So this amount we do have to pay tax. No additional depreciation, so this is 0. So we got unlevered cash flow. Now remember, this is perpetual cash flow. To get a present value, we use annual cash flow 92,400 divided by discount rate R sub 0, 20%. Then subtract initial cost for 75,000. So this gives us net present value of negative 13,000. Once we got net present value, APV is net present value plus the debt financing effect. In this case, we don't have bankruptcy cost, we don't have flotation cost, we don't have other local subsidy. So the main debt financing effect is due to the interest tax shield. So remember, we have amendment proposition 1, firm value of the present value of debt amount. So it's simply the tax rate TC time amount of the debt. Tax is 34%, debt is 126,229.5. So this is the amount of present value of interest tax shield. So the APV is positive 29,918. Now let's take a look at how the flow to equity work. Flow to equity, we have to use levered cash flow, cost equity, and stockholders' initial investment. From unlevered cash flow, 92,400, we will subtract after-tax interest payment. The debt is 126,229.5, cost debt 10%. After tax is 1.1 subtract 34%. So levered cash flow is 84,000 and $68.85. Use proposition 2. We start with R sub 0 and the equity ratio, debt is 25%, equity is 75%. Okay, cost of debt is 10%. So we got the cost of equity is 22.2%. So how much is amount investment contributed by equity holder? The initial investment is 475,000. The debt is 126,229.5. So the difference is amount invested by equity holder. Put them all together, we use levered cash flow discount at the cost of equity, and we got flow to equity to 29,918. Based on the previous two approach, we can easily find the WACC as we will use unlevered cash flow and the WACC discount rate. Remember debt to value is 25%, which means that to equity to value ratio is 75%. From previous slides, we got cost equity 22.2, and the debt is 10%, so WACC is 18.3. From APV, we got unlevered cash flow 92,400. So discount at WACC, subtract initial investment, we got net present value using WACC approach is also 29,918. So this is a simplified example. We went through the three approaches. Now I'm going to give you another example, Pearson example, where the cash flow is no longer perpetual. This project lasts for 4 years. So the setup is follows. For an all-equity firm, initial investment is $1,000. They already calculate after-tax cash flow, means sales minus revenue. They already calculate after-tax cash flow, sales revenue minus expenses, times 1 minus tax. So the after-tax cash flow is 125, 250, 375, 500. The unlevered cost equity is 10%. So the first question is what is net present value? Second question, what's annual interest tax shield? Lastly, what's APV? So let's try. So we will put these after-tax cash flow into our net present value equation. And at 10% discount rate, we got net present value is negative $56.50. Now let's look at the annual interest tax shield. The company could borrow $600 at 8%. So the annual interest payment is $600 times 8%. The annual interest tax shield is 40% of this amount. So every year, company will save $19.20 due to the interest tax shield. So now how much is the 4 years value impact? So we will use annuity approach, the 4 year of the 19.2, discount at 8%. Remember this, we don't use sub-zero. We will use cost of debt to discount annual tax interest shield. Put them together, we got this. According to APV, this project will bring in $7.9 to this company. Now we will use same Pearson example, talk about how what we solve use FTE, flow to equity approach. So again, we have to look at the levered cash flow, cost equity, initial investment. So initial investment 1,000 with $600 borrowing, so the equity holder need to contribute 400. Now let's look at the levered cash flow. Levered cash flow equal to unlevered cash flow minus after-tax interest payment. The interest payment is 600 of 8%. Then we time 1 minus tax 40%. So the after-tax interest payment is $28.80. So according to the unlevered cash flow, we will subtract the 28.8, which is after-tax interest payment every single year. Recall, I also update initial investment by equity holder 400. And one thing I want to ask you pay attention to is in the last year, company have to pay off debt, right? You borrow 600, in the end you need to pay off 600. Okay, now let's take a look at cost equity. We will use amendment proposition 2. So we know R sub 0, tax rate, cost of debt. The thing we want to discuss is the equity ratio. If the target debt equity ratio is given, then we can use this directly. If the equity ratio is not given, then we need to calculate the equity ratio. We need to use the market value of the equity. So, for example, we know initially equity holder contributed 400, right? Okay, so that's book value. When we take this investment, remember this investment will bring in $7.9 increase in the firm value. So which means the equity value will increase by $7. Look at it again, right? So if we use a APV approach, we will get PV based on the after-tax cash flow. We got that the value of the project will become $1,007, 7.09. So subtract the loan amount, 600. The market value of stock equity is $407. So we have to find out the equity ratio use this market value of equity, not the book value. So now let's go to the amendment proposition 2 again. Then cost equity is 11.77. Now let's put them all together, use levered cash flow, the cost equity, and 400 initial investment. We got net present value is $28.56. WACC is a bit easier as we already calculate a lot of things. Based on the new equity amount, $407.09, and we can easily figure out the cost with average cost capital based on cost equity and the new capital structure weights. So use the unlevered cash flow and full amount initial investment. We got the net present value based on WACC as $5.67. So this is second example where the structure is a finite cash flow. We only have 4 years, and one of the things I want to ask pay attention to is whether the capital structure is based on the target the equity ratio or not. If not, you have to estimate the equity ratio or proportion of debt, proportion of equity. Let's summarize the difference among three approaches. Okay. APV and the WACC is similar as they have the same amount initial investment, use the same unlevered cash flows. APV will address financing effect in a separate component. WACC will respond to financing effect in the discount rate. Flow to equity, everything is different. Look at the equity investment, levered cash flow, cost of equity. All three approach has different discount rate. So how do we choose which one to use in practice? So APV works best when we have a constant amount the debt or the amount of debt is giving. Even they have, for example, they want to reduce debt every single year. That also works because we know amount of debt every single year. WACC and flow to equity works best when we know the debt ratio, whether this is debt equity ratio or debt to firm value ratio. If the debt equity ratio changes every single year, then the WACC and cost equity also change every single year. That will make calculation more difficult. WACC is still by far most popular approach in practice. FTE works also well for a highly levered firm. So I summarized general formulas for three approach. One thing I also want to emphasize is the discount rate for the risk-free cash flow and the risky cash flow. When we talk about interest tax shield, flotation cost, or depreciation tax shield, all these viewed as a riskless cash flow, safe cash flow. So they all discount at the cost of debt. The operating cash flow, sales revenue, so on and so forth, they typically discount as sub-zero. I have one more example on APV where we will consider both flotation cost and interest tax shield. The company is considered a $10 million project, a 5-year project, straight line all the way to zero, $2 million per year. The revenue minus expenses is $3.5 million. Tax is 34%, risk-free is 10%, cost of unlevered equity is 20%. For the financing opportunity, company could obtain a 5-year non-amortized loan for $7.5 million after paying off flotation cost. The cost borrowing is 10%. Flotation cost will be 1% of the amount borrowed. What is APV of this company? Let me first explain what do we mean by non-amortizing loans. So non-amortizing loan means pure interest loan. So from year 1 till year 5, every year the company pay interest payment, do not pay off any of the principal loan amount. At the last year, year 5, the company will pay off the loan amount. So let's first look at the net present value for all equity version. Okay, we just put aside the loan, flotation cost, interest payment. Let's look at the one without any financing effect. So the purchase is $10 million. Sales revenue minus expenses is $3.5 million. So this amount we have to pay tax. Then we have $2 million depreciation discount. Then we have $2 million depreciation every single year. So we times 34 to get the depreciation tax shield. Now I highlighted the different discount rate. Remember, recall depreciation tax shield is viewed as safe cash flow. So we discount at cost of debt 10%. While sales revenue is risky cash flow, we discount at as of 0, 20%. So the net present value based on these 5-year, net present value is negative 513,951. Now let's take a look at the loan financing activities. Company want to borrow net amount $7.5 million. So you need to address the flotation cost. After paying off flotation cost, which is 1% of the borrowed amount, we want to get 7.5. So the exactly amount we have to borrow is a bit more. How much? 7 million divided by 1 minus 1%. So we actually have 7.575757.58 million dollars. Now the flotation cost is 1% of this amount, so it's 75,757.58. So if you subtract these two, you will notice the net proceeds left is 7.5 million. That's exactly what we need. So I put this amount here. I did not give you the final answer. I just give you how we get this number. So this is the gross loan amount we borrowed. This is the flotation cost we have to pay. So every single year we have to pay interest payment. At the end of year 5, we have to pay principal repayment of the loan amount we borrowed. We also have flotation cost and the flotation cost tax shield. Let's look at detail. So we got the loan amount. So 5 years later, we pay off the same amount. So interest is 10%. So annual interest payment 10% of the loan amount. The tax shield is 34% of the annual interest payment. Right. So put these two together, the after-tax interest payment goes to the lenders is 1 minus 34% of the annual interest payment. Now the total flotation cost is $75,757. So this company paid one time at time 0. But we will spread the cost over the next 5 years, and we could deduct these and the flotation cost from taxable income. So this will give us the tax shield on the flotation cost. How much? The flotation cost is 75,757.58. So that is it's one time. We will spread the cost evenly across 5 years. So we divide 5 to get annual flotation cost. We use this amount to be deducted from taxable income. So this will provide tax relief or tax shield. So how much? 34% of this. So this just gives you a picture what's happening with the loan activity and what happened to the flotation cost. Right. So let's look at the calculation altogether. So in year 0, we borrow 7.5 million divided by 1 minus 1% flotation cost. So we have to borrow a bit more. So this is a loan amount. So year 5, we have to pay off this amount. So annual after-tax interest payment is 10% cost of debt times 1 minus 34% rate. So time 0, the loan amount minus the flotation cost, the net amount we raised is $7.5 million. After tax interest payment every year, then we use annuity factor of 10% for 5 years. The flotation cost tax shield is also 5-year effect. So lastly, year 5, we have to pay off the loan amount, which is a bit more than $7.5 million. So this altogether give us the total finance effect will be positive 920,187. And on top of our net present value, we got APV is 406,236. So this is a bit long question. But basically, we need to know that what is amount of a loan we borrowed, how do we adjust for flotation cost. Then the two type of the finance effect here is one is interest tax shield. The second is flotation cost tax shield. So once we know the loan amount, flotation cost, what's annual flotation cost, the tax shield is just 34%, right? So all of them we will discount. We use 10% cost of debt to do the annuity factor, to do the present value factor. Here is another example for APV with flotation cost. So I want you to take out your scratch paper and try that. Okay, give it some time. Here is another example for APV.